So learning objective 2 and learning objective 3 are all about those adjusting entries, right? The accounts we're double checking before we finalize our income statement. Okay. So the first accounts we check are something called deferrals. And to defer simply means you're postponing or delaying. Okay. And so what you'll see in all these accounts, there are 3 asset accounts we check and 1 liability we check, because we have to wait to use assets before we expense them. And in the case of the liability, we have to wait to earn the money before it becomes our revenue. So we're going to be looking at those issues here. So again, prepaid expenses, basically, they start off as assets. So for example, supplies is an asset. It's on your balance sheet as a current asset, right? But you use up supplies very quickly. After you use up the supplies, it becomes an expense, right? It becomes the supplies expense. And so prepaid expenses basically start as assets. After we use them, so we have to wait to use them. That's the deferral piece. We have to wait to use them. But once we use them, they become an expense. Supplies, prepaid insurance, things like that are examples. And then we have unearned revenue. Remember, unearned revenue means the customer gave us money up front. It's a liability account. Now, why did the customer give us money up front? Well, because we owe the customer a service. Right? Well, once we actually deliver the service, we don't owe the customer that anymore. As a matter of fact, that liability, once we actually deliver what we promised, becomes revenue. So as you see here, it goes from the balance sheet to the income statement, and that's important to know. But we have to wait. Defer is to wait. So you're going to see 3 examples of prepaid expenses and 1 example of unearned revenue that you need to learn. Okay. You already are familiar with some asset accounts. You know about
Can
prepaid.
you go back, please? 1 slide.
Yep.
Thank you.
You already know about prepaid insurance. You've seen that account already. You already know about supplies. You've seen that account already. So you're familiar with those 2 accounts. They're current asset accounts. What you might not be familiar with is prepaid advertising is also a current asset, and prepaid rent is also a current asset. So those are other accounts that are prepaids in essence. The equipment and building accounts are property, plant, and equipment, right? They're long-term assets. All these other ones are current assets. And so they're going to be used over a long period of time. And the method that we use to expense long used assets is something called depreciation. And so you're going to learn a little bit more about that today. Okay. So again, prepaid expenses start as assets, end as expenses when we're done using them, which means that when we're done using them, we have to make an adjusting entry in the journal. Remember, everything starts in the journal with a journal entry, everything. That's why you can never forget anything from chapter 3, because it just simply repeats over again. So the entries that we're going to be making is a debit to the expense account, such as supplies expense, for example, and a credit to supplies, for example, whatever the asset account is, right? So prepaid expenses work the same. It started as an asset. We have to wait to use it. That's the deferral piece. Once we use it, it becomes an expense, and that means we have to make an adjusting entry to show that expense. So basically, we debit the expense account, and we will credit whatever asset has been used. So here is the very first one that you're going to be learning about is supplies. So you remember Sierra Corporation started off with $2,500 of supplies at the beginning of October. Okay. Well, at the end of October on the 31st, they only had $1,000 of supplies on hand. So this on hand simply means left over, right? Physically there with them. So if you started with $2,500 of supplies and you ended with $1,000 of supplies, you used up the difference. You used up $1,500 of supplies, which means you need to expense them as of October 31st. You have to expense them in the period that you use them. Okay. And so what we have here is the proper the proper entry in the journal. We debit supplies expense for $1,500. That's how much we've used. And we have to credit supplies, right? What happens to everything that we put into the journal? Well, you know what happens to it from chapter 3. It gets posted in their ledger accounts, right? We post everything. And so what you see is after this adjustment, the supplies account, which is an asset, shows $1,000 of supplies left, which is exactly what we do have on hand at the end of October. So that's correct. And because we've used up the difference, we now have a supplies expense for October, because now we show we have used those supplies that month. It happens at the end of the month because it's got to match the period, right? The shortest period we measure is a month. So we have to sort of wait to do this at the end of the month, for example, in this case. Insurance, again, starts off as an asset. When Sierra Corporation bought that insurance policy in early October, they bought a 1-year insurance policy, and we said that was an asset called prepaid insurance, right? Well, why? Because you bought a full 12 months of coverage. Okay. You can't expense it when you buy it because you haven't used it yet. You have to wait until you use it. That's the deferral piece. You have to wait to use it, and then you can expense it. So this $600 was good for a whole year. So that means that every month that goes by, you've used up $50 of this insurance policy, because that $600 is for a full year. That's $50 a month. So now we're at the end of October. We have already used 1 month of this insurance policy. We can expense the piece that we've used, $50. The journal entry is a debit to insurance expense for $50, a credit to prepaid insurance for $50. Everything that goes, again, this is a journal entry. You know what happens. From the journal, everything gets posted into their ledger accounts. So now what you see is an updated ledger. At the end of October, we only have $550 of prepaid insurance, which is correct. We have 11 months of insurance left on that policy. We've used up 1 month, which is why we can expense 1 month of insurance at the end of that month. So this is an example. This is the second one you have to know. The third one is a little bit more detailed, because I think you don't really understand too much of this yet. There's a whole chapter dedicated to this later on in chapter 9 that you'll learn a lot more about. But as for now, you need to know a few things. One is property, plant, and equipment accounts, such as buildings, equipment, or motor vehicles. They are recorded as assets because the company is going to use them for a long period of time. They determine how long they're going to use it for the business. So that's called a useful life. All right. So for example, when UPS purchases a new delivery truck, that's an asset to the company. But one of the first things they have to decide is how long is this going to be useful to the business, right? All of these types of things eventually break down or become obsolete. And for UPS, they have to make sure that they're delivering packages quickly because that's what they promise. So they're not going to wait forever to use a truck and keep repairing a truck over and over and over again and ruin that delivery schedule. So they might decide they're going to have a useful life of a truck of, say, 4 years, and I'm just making it up. Okay. Well, over that 4-year period, they can start the process of allocating some of the cost, right? The amount of money they spent to buy that truck. They can start to allocate some of that to what's called depreciation. In other words, they can start slowly expensing the value of the truck that they're using in the business to deliver their packages. Okay.
Are the packages added to their accounts as assets when they get shipments and then taken away?
No, not at all.
No, they're not put in the ledger at all.
It's not their property. So it's not their property. So we're talking about specifically what they own. They own the trucks. They don't own the packages on the trucks. They're simply delivering the packages on the trucks. That's their revenue. The fact that they pick up packages and deliver them, that's a service they're providing. That's all they do. They don't own any of that stuff. They simply deliver.
So it would all be written in as a service then?
It's service revenue for delivering the package. Mm-hmm. But I'm talking here about depreciation, which only happens on, in this example, on the truck. Okay. So for that, again, we use this process called depreciation for things like buildings, equipment, motor vehicles, because they only last so long before they have to be replaced. In other words, they have so much of a useful life to the business before they have to be replaced. So that takes many years in many instances. So it's a very slow process for depreciation. Sierra Corporation did have equipment, and they're obviously going to have that equipment for a number of years, maybe 10 years, and they're slowly going to depreciate some of that equipment slowly year to year. So they've decided that they are going to depreciate $480 a year on that equipment, or $40 for every month that they do their records, right? And so what's going to happen is a journal entry at the end of October, at the end of every month in this case, for a depreciation expense of $40. Now, we don't put the credit to the equipment account. The equipment account has sort of a buddy account called accumulated depreciation on equipment. You probably saw this back in certainly in chapter 2 when we did a classified balance sheet. The cumulative depreciation account was there on that balance sheet. And it basically, again, the depreciation expense is going to happen a little at a time, but the balance sheet's going to show how much of the equipment we have actually expensed over time. That's the accumulated part. Okay.
How do they decide the depreciation value?
Yeah, chapter 9, we're going to get into the details of that for sure. There's several methods they can use to determine that, but we'll get into that in more detail in chapter 9, promise. So in this case, everything that goes into the journal, as you know, gets posted into the ledger. So the debit to depreciation expense now shows as a depreciation expense in the month of October. And this $40 in accumulated depreciation will go into the accumulated depreciation account for equipment. It goes on the credit side. This particular account is technically an asset account, but it's an asset account that has a credit balance. It's called a contra asset account. A contra account in accounting simply is an account that has an opposite normal balance to all the other accounts in that category. So this is a contra asset account because it's an asset account, which normally have debit balances, but a contra asset account has a credit balance. That's the contra piece. Okay. So this is important to understand. You're going to get more detail, as I was telling Greg, in chapter 9. But this is sort of an introduction to the idea that businesses depreciate their property, plant, and equipment over a long period of time. So basically speaking, what they have on their balance sheet, they usually will show the assets or the equipment here at the value they paid for it. And then right underneath the asset, they will show how much of the equipment they have expensed over time. That's the accumulated. So this, they just started expensing it, so that's only $40. The $4,960 is what we call the book value of the equipment. A book value is simply the amount of the equipment that we purchased new minus the amount we have already depreciated or expensed in this case. Okay. So what if we didn't do any of these type of things? I want to point out two things here. One, that's very important. Remember, everything we do here is going to affect revenue and expenses because the income statement is the first statement we are doing. So we have to make sure that all the revenue and all the expenses are there. So if we didn't do these deferred expenses, our expenses would be missing from the income statement, which means our expenses would look a lot smaller. That's the understated part. If your expenses look smaller, your profit looks bigger than it really is. And that wouldn't go over so well, right? Also, because you didn't reduce your assets, it still looks like you have more assets than you do, which is the overstated part. Okay. And so it's very, very important that we do these adjusting entries for these accounts. And there's three of them that you had to know here: supplies, insurance, and equipment. The deferred revenue account is in the category of a liability called unearned revenue. Remember, the word unearned revenue means it's a liability. It's unearned. You owe the service to the client. And this is actually very, very common in a lot of businesses. There's a few that are listed down here that I'll talk about. So I'll talk about the airline tickets, for example. If you purchase airline tickets to go away, say this summer, you want to get the hell out of here, and you buy airline tickets today to go to Florida, the airline is going to put that down as a liability for them. That money that you've given them to buy the ticket is a liability, unearned ticket revenue. Why? Well, because they owe you the flight to Florida. Okay. Once the flight time, date, and time arrives, and the plane is getting ready to take off, they have earned it. So it goes from a liability to a revenue, right? It goes from the balance sheet as a liability. Remember, unearned revenue is a liability. That's on the balance sheet. But after they actually do the work, it becomes a revenue. It goes to the income statement because now they've earned it. Revenue is earned. That's why it's on the income statement. You've already did the work. That's why it's there. Any customer deposits, you might have purchased, you might have put a down payment on a cruise. Not that you're going anywhere these days, but just saying. Well, or you might have purchased, you might have put a down payment or deposit on a stay at a hotel. Let's stay back in Florida here. Or bought Disney tickets up front. Yeah.
Would gift cards and stuff like that be unearned service revenue?
Yes. Yes. It is. It's an unearned revenue. So if you did purchase, if you put a down payment on a cruise, if you paid for your hotel up front, for example, or you paid ahead of time for tickets to Disney or some other venue, that's all unearned revenue to those companies. They have to put it on their balance sheet as a liability because they owe you what you paid for. Okay. Once the day of the cruise is there, they can call it revenue. But the process is part of the adjustment because you're changing it from a liability to a revenue. That's what you're learning how to do. This doesn't happen automatically. What we have to do is lower the liability, which is a debit to the liability account, unearned revenue. And we have to credit the revenue because now it's revenue, right? So we lower the liability account and increase the revenue account. And so that's how we deal with this. So remember, Sierra Corporation had a client, R. Knox, who gave them $1,200 up front in October. They put that as unearned service revenue. However, at the end of October, they evaluated the services and they've determined that, hey, we actually provided $400 worth of tours to our client, R. Knox. So we don't owe that person $1,200 of tours anymore because we've earned 400 of it. So what do? They do an adjusting entry. That's what you're learning. They take it out of their unearned service revenue. Remember, this is a liability account. They're reducing their liability and they're putting it into their service revenue account, again, because they've earned the revenue. Once that gets posted in the journal, look what happens. The liability decreases to $800. And their service revenue now has increased because they say they can earn it. So again, very important to understand why we're doing this. If we didn't do it, our liabilities would look smaller than they are. And that's a problem because remember, your revenues would look a lot smaller than they are. That's a huge problem. Revenue is where the profit is. You can look at the income statement, you look at it, it starts with revenue. You take away your expenses. What's left is your what we call net income. But you can also say it's leftover revenue, right? Because if revenue is bigger than the expenses, what's left is just the rest of the revenue. We call that the profit. So if your revenue is understated, if you didn't do this adjustment and put that money into the revenue account, your revenue would look smaller and your profit would look smaller. Okay. Also on the balance sheet, your liability account would look bigger. It looks like you're indebted to people much more than you already are. And that's why we have to do this adjusting entry. Okay, that's why it's super important. So again, the do it exercise for learning objective 2 simply is a review of this. So here's a ledger for Hammond at the end of March. They have prepaid insurance, supplies, equipment, and unearned revenue. And 4 things happened at the end of March that they have to adjust. They have to do an adjusting entry for. Means, again, this goes into the journal. So the first thing is they used $100 of that insurance. The second thing is they only have $800 of supplies left. The third thing is they had depreciation of $200. And the fourth thing is they earned $4,000 of this $9,200. They earned $4,000 of that. And so they're asking us to prepare the entries. Well, the first thing is if insurance is used up, we debit the insurance expense, credit prepaid insurance. Okay. So that's how the first one would end. The second one, we had $800. Well, look, if you started with $2,800 in supplies and now you only have $800, you used up the rest. You used up the $2,000 difference. So that's what you can expense. You can expense what you've used. So you debit the supplies expense, credit supplies. Here, they're just giving you the amount of depreciation for the month, $200. And so what we would do here is debit the depreciation expense, $200, credit the accumulated depreciation for equipment. I would have added that to this, a shortcut here, but that's the actual name of the account. That's what should be here. Okay. And the last thing is you perform $4,000 of services. So you have to lower your unearned service revenue. Remember, unearned service revenue is a liability. $4,000 of that needs to be in your revenue because you've earned it now. And so we debit the liability account by $4,000 to lower that, move that $4,000 into the revenue account so we can show it as revenue.
Can you spend unearned service revenue before you give the service?
I'm not sure I understand the question. So if if um, if you give someone cash, can they use that cash without providing you the service? It's hard to track, but technically they can use any of their assets to do various things that they need to, as long as they satisfy their liability, their obligation. You know, I mean, it's so I'm not sure what that what you mean specifically, but that's
Well, companies will take the unearned service revenue and use it before the service is provided, but then the service is never provided. So,
there's no no it's a liability. The only thing they can use is the cash that you give them. They can't use unearned service revenue because it's a liability. They owe that to you. So I'm not sure how you can use it, but they can certainly use the cash they give you that you give them up front before they actually provide you the service.
okay.
Okay, but so that's what I meant. All right, so let's continue. We have three more. We're going to do the accruals now. But as you see, the adjustments sort of are practical, and all the adjustments reflect needing to recognize an expense or needing to recognize revenue, because you have to do your income statement first. So that has to be pretty solid. Okay, so we're going to continue on with objective 3, which is simply more adjusting entries. Okay, but this time objective 3 looks at what we call accruals. And accrual, unlike deferrals, remember deferrals, you have to wait to use it before you can expense it, or you had to wait to earn it before you can say it's your revenue. Accruals are sort of looking very much like the opposite. You're going to record the revenue today in this period, even though you're not going to collect it until later. You're going to recognize the expense in this period, although you're not going to pay it until later. That's the accrual piece. So there's 3 of these that you're going to look at: accrued revenues and accrued expenses. So again, the revenues, you've already did the work, but you didn't put it on the books and you haven't collected any money. So that's simple to resolve because you have to send the client a bill and record the revenue in your books. That's very simple. The expenses are always one of those interesting things that expenses happen in various periods of time, sometimes without being paid. And you're going to learn about 2 of them in this part of the chapter. Okay. Accrued revenue is the easiest to understand because you've already performed the revenue, but you haven't yet received any cash or recorded it on the books. So what happens when you perform a service and you forget to write it down? Well, you basically have to do an adjusting entry. Okay. You have to create a receivable to show that you're waiting to receive the cash, but make sure you record that revenue in that period of time that you earned it. Right. So this is actually quite easy. We're going to be debiting accounts receivable, and we're going to be crediting cash when we see this. And the next example is an illustration of that. Sierra Corporation actually did work before October 31st for $200, but they didn't bill the client. This is an accrued revenue. So they've actually earned the $200 in October, so it should be recorded for October, but they haven't collected it yet. They haven't gotten paid yet. So they got to set up a receivable. So the solution would be to do an adjusting entry by debiting accounts receivable, that's the bill, the client, you're waiting to receive money, and recognize the $200 of revenue that you did. Okay, so it shows up on your income statement. Once this gets posted into the ledger, you'll see accounts receivable balance is adjusted and your service revenue is adjusted. Look how much service revenue started at 10,000, but after the adjustment process, you've added another $600. That's just not revenue in there. There's profit in there too. Right? Very important. Don't miss your revenues and expenses. So if you didn't do this, your revenues would look smaller and your assets would also look smaller. So you'd lose on both sides. So it's required to do the adjusting entry for an accrued revenue to make sure that doesn't happen. And again, accrued expenses, they are expenses that happened in a particular period of time, like the month of October, for example, but you haven't paid them yet. The book is going to teach you about two of them, interest on loans and salaries, a salary expense that you must take in the month that the employees work, even though the payroll might not be till the next month. So let's take a look first at how we do this. So first we're going to, basically we're going to record a payable in order to recognize the expense in the period of time. So again, we need to make sure we are recognizing the expense, but because we haven't paid it yet, we're going to record a payable. Payables are liability accounts. So you'll see two of them here. The first one, accrued interest, is very interesting, for lack of a better word, I guess. Basically speaking, Sierra Corporation had that 3-month note payable. Okay, so how notes payable work is you don't pay back the loan or the interest on the loan until it's due. So this note was taken on October the 1st, and it's not due until 3 full months later, which would be January the 1st, November, December, January. January the 1st would be the due date. So on January the 1st, they're going to pay back the full loan and all the interest on the loan, all in one payment on January the 1st. However, anytime a business has a loan and has interest on that loan, the interest on the loan is a business expense. Okay. So not the loan itself, the interest on the loan is a business expense. We call it interest expense. And so because Sierra Corporation actually had a loan in October, for the whole month of October, literally that note accrued interest in October. How much interest did that note accrue in October? Well, that's what this formula shows you. $5,000 is the amount of the loan. 12% is the annual rate. Remember, the annual means all 12 months. We only need to know the interest for October. So we multiply that by the time factor of 1 month over 12 months. That gives us $50, which means that this note payable accrued $50 in interest in October. It will also accrue $50 in interest in November and again in December. But we're not going to pay that until it's due on January the 1st. But we have to keep our record accurate. So in October, this note cost us $50, even though we haven't paid it yet. So we are going to record an interest expense for $50 for the month of October for this note. We are going to set up something called an interest payable, a liability account, showing that we will pay this later. Okay. And that's basically interest payable.
Is this a consistent formula?
Yes.
Okay.
Yes. Very consistent. And again, because we're only looking at the expense for, say, a month, we're usually going to use 1 month over 12. The interest rate's always going to be annual. But if you're only looking for 1 month's interest, we need to use this additional factor here. Okay. So here you show an interest expense for the month, and of course, interest payable. Now we have another liability on the books. Accrued salaries is something that everyone, I think, can understand because you know you work and then you wait for the next payday, right? So, well, what happens if that next payday happens in next month? Well, look at Sierra Corporation's payroll. Their very last payday of October happened on Friday, the 26th. Now, this is a 5-day work week they only work Monday to Friday at this company. And so look at the very next week. They have Monday, Tuesday, and Wednesday, all are in October. However, they're not going to get paid until November the 9th. But these 3 days of work happened in October. They need to be expensed in October. We have to match the expense to when it happened, right? So these 3 days of work need to be expensed in October. Well, how much is payroll? Well, $2,000 of payroll for a 5-day work week. So in other words, $400 a day for payroll. So if they have 3 days of work in October times $400 a day, $1,200 worth of salaries and wages need to be expensed in October, although they're not going to be paid until November. So that requires an adjusting entry. And the adjusting entry simply is a salaries and wages expense for $1,200. That's the amount of those 3 days that happened. Will be expensed in October, setting up a liability, salaries and wages payable, show we're going to pay it later on the books. That's the journal entry. You know what happens. Anything you put in the journal gets posted into the ledger. So look, now salaries and wages expense has expanded, has grown, has become a larger expense in October with this adjustment. But now we also have to show the liability on the books that we're going to pay that salaries and wages later. So that should make sense to a lot of people because you all have worked at one point in time. So if you didn't do that, your expenses would be missing, which means your expenses would look smaller and your profit would look bigger, which is a problem. Another thing you would do is, well, this is a misspelling, your liabilities would look smaller as well because you wouldn't show those as liabilities on your books. But I think a labability might be for specific dogs that are involved in accounting. All right, so that's why we have to do this adjusting entry. That's why it's super important. This summary is, again, learning objective 2 did your deferrals, learning objective 3 did your accruals. But if you notice, every single adjusting entry is going to impact an income statement account and a balance sheet account. But specifically, why we're doing this is we want to make sure that when we put our first financial statement together, which is the income statement, it's as accurate as possible, which means all the revenue and all the expenses are going to be there. Learning objective 3 ends with a do-it exercise for microcomputer services that started business on August the 1st, and now it's the end of August. And 3 things are happening. The first thing they notice is they owe employees $800 for August salaries this won't be paid till September. The second thing is they borrowed money. Okay, so they're going to have an interest expense. We don't care how long they borrowed the money for. All we care about is how much interest happened in that period of time that needs to be expensed. This period of time is simply 1 month. Okay. And the last thing is that we performed revenue, but we didn't report it. How silly. So we have to do an accrued revenue there. So one at a time. When you know you have employees to pay, you have to set up the expense for August. So August 31st would show a debit to salaries and wages expense and a credit to salaries and wages payable for $800. Okay. This is usually the most time consuming, right? Because you have interest to calculate. So they had a loan. Yes, it's 15 years. We don't care. We only care about August in this case. How much of this loan interest happened in August? Well, you take the $30,000. That's the amount of the loan. You multiply it by 10% That 10% represents all 12 months. We only need for 1 month. So you multiply that by 1/12. What you get is interest of $250. And so you would have an interest expense for $250 and set up the payable for $250. The last thing is you certainly perform this, but you forgot to record it. So set up a receivable to collect your money and put that money in revenue. Okay. And those are all of your adjusting entries. There are 7 in total that you have to know. 4 of them are from Learning Objective 2. 3 of them we just went over in Learning Objective 3. Any questions?